Dear students, we will do module 38. This is about computation of net annual value. So vacancy allowance, unrealized rent, adjustments we will explain in this module. So let us go to the first problem. 8 problems we will do in this module. And first problem, Mr. A has a house in Bangalore which is let out. Its municipal rental value is MRV 1,08,000. 1,08,000. Fair rental value 1,20,000. 1,20,000. Now, and the standard rent is 1,02,000. 1,02,000. The question is compute the expected rental value. So when is standard rent is given, you know that between these two values, whichever the higher value we have to take, it is 1,20,000. Between these two values, the lower value we have to take. So expected rental value is 1,02,000. This is the first problem. Now the second problem, A has a house property in Bangalore which is let out. Its municipal rental value is 1,08,000. MRV is equal to 1,08,000. 1,08,000. FRV 1,20,000. FRV is equal to 1,20,000. 1,20,000 and real rent is 1,02,000. Real rent is equal to 1,02,000. So what is the expected rental value? Here you have to remember standard rent is given. So how you will find out? Between these three values, whichever the higher value will be the expected rental value. So it is 1,20,000. This is when standard rent is not given. Now standard 3, 4 situations I am explaining. First one is MRV 1,20,000. Second is FRV 1,50,000 and real rent is 1,38,000 and standard rent is not applicable. So MRV 1,08,000, FRV 1,20,000, 1,20,000. Sorry, MRV is 1,20,000, 1,20,000, FRV 1,50,000, 1,50,000 and real rent is 1,38,000. Standard rent is not available. So how to calculate this? Not applicable. That meaning between these values, whichever is the higher value. So it is 1,50,000 is the expected rental value. Now situation B, MRV is 96,000. MRV is 96,000. 96,000. FRV 1,20,000. 1,20,000. Now next is real rent is 1,08,000. Real rent is 1,08,000. Next is standard rent is 1,44,000. So first we have to calculate. First we have to calculate between MRV and FRV whichever is higher, 1,20,000 and between this and this whichever is less. So expected rental value is 1,20,000. Now here real rent is given, so you have to compare that with real rent 1,08,000. Between these two, whichever is higher we will take. So here expected rental value is 1,20,000. You have to remember situation C and D, you have to check that after completing expected rental value, compare with real rent. If real rent, between expected rental value and the real rent, whichever is higher we will take. So you can compute the section C and D accordingly. Now problem 4. Problem 4. MRV 10,50,000. MRV is 10,50,000. 10,000. Sorry, 10,500. MRV is 10,500. FRV is equal to 10,700. 10,700. Next is standard rent is not available. Standard rent is not available. Not available. And annual rent is equal to 10,300. 10,300. Unrealized rent is 1,000. Unrealized rent is 1,000. So this problem I want to give the adjustment for unrealized rent. And duration of the previous year is 12 months and vacancy allowance is not there. Say 5 situations are explained. One situation I will explain. The same way you can calculate. So here you have to remember expected rental value. Standard rent is not there. So 10,700, whichever the higher value available. So this is 10,700. Now actual rent received meaning, see annual rent minus 1000, it is 9300. So unrealized rent, whenever in the situation it's given condition satisfied, you have to reduce that value. So with how to calculate gross annual value, step 3 and step 4 value whichever is higher. Step 4 is vacancy allowance. Vacancy allowance is not there because duration of the year is 12 months is given. So 10,700 or nil, whichever is less. Between these two, whichever is higher is the expected rental value. So 10,700 is the third step value. Fourth step is vacancy allowance, it's nil. So gross annual value is 10,700. So this, like this, you can calculate for other situations also. Unrealized rent, reduce it from the annual rent. Now compute the gross annual value. MRV 60,000, FRV 68,000, SR standard rent is 62,000, annual rent is 67,000, unrealized rent is 2,000 and loss due to vacancy 1,000. So here we will adjust the loss due to vacancy also. So I will explain one. MRV is 60,000. MRV is equal to 60,000. FRV is equal to 68,000. 68,000. Next is standard rent is 62,000. Standard rent 62,000. Next is annual rent 67,000. 67,000. Unrealized rent is there. Unrealized rent 2,000. And loss due to vacancy 1,000. Now how you calculate the gross annual value? So you have to remember expected rental value. Standard rent is there. Between these two values, whichever the higher value you are taking, 68,000. Between these two values, whichever less you are taking. So 62,000 is the expected rental value. Now rent actually received, that is annual rental value minus unrealized rent. 67,000 minus 2,000, it is 65,000. Now vacancy 1,000. So gross annual value, how will you reduce? 65,000 minus 1,000. So that is equal to 64,000. Like that you can calculate for the other situations given in the problem. 5 situations I have given. Now problem 6, MRV 4,80,000 per annum. Compound rent received 5 lakhs. Lift and some maintenance charges paid by the owner 60,000 per annum. Salary of common gardener and watchman paid by tenants to the owner is rupees 5,000 per month, and actual expenses incurred by the owner during the current previous year 24-25 is 42,000. Here I have to tell you that it's the compound rent is 5 lakhs. Maintenance charges is 60,000. So actual rent received is 5 lakhs minus 60, it's 4,40,000. So the question is, this problem is about compound rent adjustment. So you are getting actual rent received is 4,40,000. That is 5 lakhs minus 60,000. Now municipal rental value is 4,80,000. 4,80,000. So gross annual value is equal to whichever the higher value. So this is the value 4,80,000. 4,80,000. Now next problem. MRV 84,000, standard rent 87,000, unrealized rent 40,000, date of completion 31/7/24. July it's completed. Fair rental value 90,000 per annum, real rent 80,000, date of letting 1/10/24. Here house was vacant for 2 months. See, it's completed in July. August and September it was vacant. It started giving for rent only from October. So that means 2 months vacancy allowance you have to calculate. Now you have to remember actually house is let out for only 8 months. So that is August to March. August, September, October, November, December, January, February, March. So all the values, municipal rental value, fair rental value, you have to reduce to 8 months. So you will get municipal rental value is equal to municipal rental value. When you reduce to 8 months, you will get 6,72,000. Next, similarly, fair rental value, you will get 7,20,000. 7,20,000. Now, standard rent you will get, standard rent is equal to 6,96,000. 6,96,000. So expected rental value between these two, whichever is higher, this value, between these two, whichever is less. So expected rental value is 6,96,000. 6,96,000. Now real rent is 80,000 per month into 8 months minus 2 months vacancy allowance, 80,000 into 12. So real rent is equal to 4,80,000. 4,80,000. Now between these two values, whichever is higher. So 6,96,000. 6,96,000. Loss due to vacancy. Now 2 months you have to reduce, that is 1,60,000. August and September house was vacant. So gross annual value is equal to 5,36,000. 5,36,000. Last problem. Rent received 1,75,000. Municipal valuation 1,60,000. Fair rental value 1,70,000. Municipal taxes 1,72,000. Again it's given municipal taxes 12% of municipal rental value and 2% of municipal taxes as sanitation surcharge. These two adjustments also we have to do. So this I will explain. First one you have to remember, municipal rental value MRV is equal to 1,70,000. FRV is equal to 1,72,000. 1,72,000. Standard rent is equal to 1,60,000. 1,60,000. Rent received is equal to 1,75,000. 1,75,000. Now annual rental value is the higher value. So this will be the gross annual value. 1,75,000. Because between these two values, whichever is higher, 1,72,000 we have taken. Between these two, whichever is lower, we will take 1,60,000. When real rent is there, you have to compare this value with this, whichever is higher we will take. So 1,75,000. Now less municipal taxes. You have to calculate 12% of 1,70,000. You will get 20,400 plus sanitation surcharge 2% of this value, 20,400, the computed value. So that is 408. Now you have to reduce 20,808. 20,808 from this value. So you will get net annual value. Net annual value is equal to 1,54,192. 192. So this is what I wanted to explain in this module. 8 problems. Happy learning. Thank you.